Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu. We've got longtime fools Jason Hall and Rick Munarriz giving a 1 to 10 rating to the company Warren Buffett famously bought shares in almost 40 years ago. It's Coca-Cola, ticker symbol KO, and we'll see if it's worth buying today. First, we'll talk about the business, including factors like industry and competition. You know the competition. A 10 is invincible. A 1 is hopeless. Rick, both of you have 8s.
Yeah, so to me, Coca-Cola, they've been around for 135 years, and it's about way more than just the cans of cherry Coke and Diet Coke that Warren Buffett drinks every day. 200 beverages, brands across sparkling, hydration, coffee, tea, juice, and dairy varieties worldwide with a presence in 200 different countries. It's a very fluid situation here in more ways than one. Unfortunately, soft drink consumption trends have been gradually dipping in the U.S. since the late 1990s, and the U.S. represents nearly 40% of Coke's business these days. But the overall business has been growing in recent years as it also puts out many of the soda alternatives. So an 8.
Yeah, I also gave it an 8 because there's the moats, true economic advantages that the brands, and again, it's just not Coke and Diet Coke. There's so many brands in the portfolio around the world that are at or near the top in consumption in the categories in those markets. That's power. It gives them pricing power in a lot of those markets. They've needed that pricing power, though, because like Rick said, the consumption trends have been negative. Volumes have actually fallen for years. Their ability to raise prices is the thing that's driven up growth. And then there's that distribution scale that they have that brought one of the big wins that it's had is its partnership with Monster Beverage about a decade ago in that growing category, that its distribution scale positioned it to be a big winner from its stake with Monster. So love the business. So many things to like about it.
For management, a 10 is Warren Buffett, who we mentioned earlier. A 1 is Homer Simpson. Jason's giving a 6, even though he grew up in Georgia. Rick's a little higher with a 7.
Yeah, so James Quincy, he's been CEO since 2017, chairman of the board since 2019, but he's been at the company for almost 30 years. Chief Operating Officer Enrique Braun and President CFO John Murphy, they've been around for even more long years. Actually, their current post for less years, but at the company also since the 1980s and 1990s, so they've been around a long time. I'd go higher if they were at their current post longer, but Coca-Cola has done some pretty cool things under Quincy in that term. They went through the pandemic, they went through aluminum can shortages, and Coke has managed to grow its revenue the past 4 years and keep hiking its dividend. That's a 7-up score for me from the Sprite maker, so 7.
Yeah, so I know a 6 is a brutal score, and probably people that have seen me on this show know that that's extremely low for management. But guys, look, this is a ham sandwich business, and it's underperformed the S&P 500 by almost 80 percentage points in total return since Quincy became the CEO in 2017. At some point, you have to grade management on returns. That 9.4% CAGR, that's below average work by management. And it's worth noting, too, that one of the levers to create value for this sort of business with the challenges they face, buying back shares. The share count's actually up under present management.
Gut thought, Jason. It's not a ham sandwich. What's the best sandwich you can have with a Coca-Cola?
Bologna sandwich.
Okay. Rick?
A grilled cheese with bacon. I don't know. I'm making up stuff now.
I'll take a meatball sub, but I'll always take a meatball sub.
Oh, that's pretty good.
For financials, a 10 is a fortress. A 1 is yikes. Both of you have 7s this time, Rick.
Yeah, so Coca-Cola, they have more than $44 billion in long-term debt, but I'm not worried about it. This is a high-margin business model. Net income margin is clocked in north of 22% for each of the last 6 years with this team. The top line has not been impressive. Revenue has been negative in 7 of the last dozen years. So growth can be better, but I can be taller. 7.
Well played, Rick. Also a 7. The reason it's not higher is you mentioned the debt. I'm also not worried about it, but I think there's some deterioration here. Debt levels are about where they were, but cash is down. Investments on the balance sheet have both fallen. We've also seen some pressure on cash flows more recently. I think that's going to be nascent. I think they're going to revert back to that. The good news, like you said, the operating and gross margin numbers are great, and the trends are a little bit better. I think that's reflective of those strong brand moats and the pricing power that's built into the business.
Jason, let's get to what everyone loves, the valuation part. How well will Coca-Cola stock do over the next 5 years, and how safe is it? 10's a sure thing. 1's a lottery ticket.
I think this is an extremely safe business. The safety score is a 9. I think the probability of losing money if you hold this stock for 5 or more years is extremely, extremely low. It's a discretionary product, but it's a cheap one. So it's the kind of thing that people buy even across weak economic environments. Super high margins. They divert a lot of the cost, the fixed cost, to the bottlers, and they make money with a lot of licensing. So that's extremely profitable, and it protects them against high fixed operating costs. But the stock valuation is high. Consumption trends are not favorable. They're starting to make some moves into other categories to try to find a little bit of growth. But the reality is that I think the challenges with those core large brands, raising prices can only stave off that for so long. And growing and acquisitions into growing categories has been a little hit or miss. Put that with an expensive stock, and I think the lower end of 5 to 10% is probably the likely return profile from here.
Yeah, I'm matching Jason on both fronts here. I like the 2.9% yield. I like how the King of Pop is also a dividend king with 63 years of hikes. It doesn't mean I have to like the valuation, just like Jason doesn't. So Coca-Cola has been trading at an earnings multiple in the 20s for nearly the last 5 years, for most of the last 5 years. A decade ago, you could have bought Coca-Cola with a trailing PE in the mid-teens, if not lower. Even if we look out to the next year or two, Coca-Cola is trading for 23 times this year's earnings, expected earnings, and 22 times next year's targets. That's not a lot of calories for light refreshment. I'm cautious here for that with 5 to 10% return, and half of that would be the dividend.
Time for everyone's favorite Top It. Jason, is there a company in Coca-Cola space that you like more?
Yeah, I'm not the king of puns like Rick, but I do think you look at a company like Coca-Cola and it seems like it's got a little bit of extra weight around the middle, and it's not the high performer you would want it to be. And I've already talked about how haven't been super impressed with management. You want a CEO that you can trust to deliver big returns. I'd rather take on a little bit of risk here and maybe get a caffeine juiced boost with Starbucks and take on the risk that the turnaround doesn't deliver, but the expectations are kind of low. I think the expectations are lower. The valuation's better. The upside is a lot stronger. Take that higher ceiling, and I'm not so worried about the higher floor with an expensive stock like Coke.
I went with PepsiCo. I didn't think I would side with Pepsi. I haven't liked a Pepsi product since Crystal Pepsi. Then again, I would pay good money to play in a sandbox filled with Doritos dust. But like Coca-Cola, PepsiCo is also a dividend king with 53 years of hikes. It's yielding a better 4.3% dividend now. It's trading for just 16 times this year's earnings, 15 times next year's forecast. Revenue has declined in just 2 of the past 12 years, unlike Coca-Cola. And its net margin, while it's less than half of Coca-Cola, that also means that its price to sales multiple is a third of Coke. So my apologies to Santa Claus and cola slipping polar bears, but I'm going PepsiCo here.
Interesting piece of trivia that I think is important to share here. As a fellow preferrer of Pepsi products over Coke, I know it's heresy, a guy from Georgia, to say that, but PepsiCo, until more recently, because of some challenges with its snack business, it's brought the stock price down. For most of the past 30 years, which is beginning about when Berkshire stopped buying Coke stock, filled that position up, PepsiCo's been the better stock for the vast majority of that time. So, Rick, I like your style.
Yeah. Team Pepsi over here too, Jason. Thank you to both Rick and to Jason. They've given Coca-Cola a solid overall score of 7.1 out of 10, down a little from the 7.7 it got last time, but in the same ballpark. This is a classic one with its 8s for business where, hey, if the stock price does tank a bit, maybe it becomes more interesting. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is a carbonated competitor to Coke. It's not Pepsi. Celsius Holdings, although they do partner with Pepsi, much like Monster does with Coke. Till then, Fool on. Sorry, I'm just a little behind this morning.
Yeah, we know.